Right. So let's continue with the current tax. Right. Very good. Now let's go back to our tax authorities here. Ghana here. Let's look at the GRA, the Income Tax Act 896 with amendments 1094. Right. So let's look at the Income Tax Act with its amendment 1094 and see something small about which income is taxable, which ones are not taxable, which expenses are deductible, which ones are not deductible. This is not a taxation class, right? So I'm not going to stress too much. I'll just introduce you to some of the income which are not taxable, which are taxable, and expenses. Those are deductible and then not deductible. Very soon you will do taxation. Then you get to understand the tax laws. If you've done taxation or you are yet to do taxation, it's fine. Those who have done taxation or they have idea about taxation or an idea about the tax laws of Ghana and then which ones are deductible, it's fine. Those that are yet to, I'm just going to brief you on it so that you know which ones are deductible, which ones are not. When you do taxation, you really understand it's better, right? So I'm not going to stress. Every country has its own tax laws, right? So with the standard leaves it open for every country to determine which items are deductible and which are not deductible. So the standard IS12 did not list items that are deductible and those are not deductible, right? Because every country has its own tax laws and its tax system, right? So what an expense that might be deductible here might not be deductible elsewhere. So to get which are deductible and not which are taxable and stuff, Ghana here we have to refer to our tax laws, right? And let's start from income small, right? So with income, your normal sale of goods, right? When you sell goods, it's taxable, so you have to include it. Gains on selling your capital assets, okay, your non-depreciable assets, right? It's taxable, okay, but the gain is computed in accordance with part 4 of Act 896. So you see, in accounting, how do we get loss or gain on disposal? We just compare the current value, okay, with the proceed, and we have a loss or gain on disposal. If you go to the Income Tax Act at 896, there's a way of computing what the gain or loss on what um gain or loss on the sale of these non-depreciable assets. Okay, so if you see gain or loss in a question, right? Well, the question might provide details. If it's from the accounting perspective, there is no, it might not be deductible. Okay, because the way we get our gain or loss in accounting is different from how the tax authorities generally how they get their loss or gain on disposal, right? But gain on selling on current assets is taxable per Act 896. Okay, but these are the computation is different from how it's computed in accounting. Then we have the depreciable assets. Okay, the depreciable assets like your motor vehicle, your building and stuff. Okay, in taxation we have classes 1, 2, 3, 4, and 5 classes 1 to 5. Class 1 is 40% reducing balance and stuff. Now, the gain or loss on disposal of depreciable assets is also taxable per Act 896 or per the tax authorities. I mean, from GI's perspective, it's taxable, but the way we compute the gain again is different from the way the tax authorities do it. So the way it is the way the gain is computed in accounting, it differs from how it's computed in what tax, right? So what you have to know is that like from the tax perspective, the gain is taxable, but if the gain is computed from the accounting perspective, then we have to in a way readjust that one. Okay, maybe the tax authorities have to give us a bigger, I mean a correct figure. We can't just use the gain or loss computed from the accounting perspective. Okay, dividend is 8%. If you receive dividend, it's 8% final withholding. So with dividend, if you receive dividend, I have dividend in the question, dividend from a resident company. Okay, um paid and received by a company, it's 8% final withholding. So we don't include it in our income and tax again. It's final withholding. So if dividend is received in a question and it's from a resident company, then you have to deduct it. You have to less it. If it's included in income, then you have to what less it. Okay. Rent received, rent is 8% for residents and then 50% for non-residents. Business rent is not final, but investment rent is final. So if it is business rent and it's business rent that we are receiving, the income we are receiving is business rent, then it should be taxed. Okay, then it should be taxed, right? Then it should be taxed if it's business rent. Then we have um yes, so we have other stuff like even if you pick the interest like if you pick interest. Okay, we said interest is taxable at 8%, but like when you pick, if this is the interest from financial institutions, a resident financial institution paid to an individual, that one is not taxable. It's exempt. When you go to section 7 of Act 896, it's there, it's exempt. Like we don't touch it at all. Okay, it's like I'm teaching tax. Let's leave the tax side. When it comes to the expenses, sections 8 and 9 mention some expenses that are not deductible. You can't deduct them. Okay, as you might know, depreciation is one. That's how we add back depreciation, fees and fines, bribes, dividends, depreciation, final withholding amount. All these ones are not taxable. Sorry, they are not deductible. So these expenses are not deductible, right? So tax payables, bribes, um, final withholding payments, depreciation. These ones are not deductible, right? So if they've been deducted, you have to add them back. For donations, donations in general are donation has a specific rule. Okay, so if the um the donation or the contribution is to a worldwide cause, it's allowed. If you look at section 97 of Act 896, section 97 talks about donations and stuff. Well, donations to charitable organizations, those are approved. Okay, those have been approved as charitable organizations. Example like the Usu Children's Home, like those ones have been approved. So donations that are approved are deductible. Um, Donations towards sports development. Okay, when you donate to the Black Stars, to the Black Starlets, whatever. But the donations, that donation should be of national interest for it to be deductible. Should be of national interest for it to be deductible. Okay, if you go and donate to um one local player who is doing something, it's not deductible and stuff. Let's leave taxation aside. I'm sure very soon, if you run on taxation, very soon you do it and you get to understand all these things, which ones are deductible and which ones are not deductible. Right? Let's look at this question. Okay, so let's get this question. It says CN Limited had an accounting profit of 786, I'm sorry, 789,000 cedis for the year ended 31st December 2024. The accounting profit was after a depreciation of 70,000. So let me align the figures. After a depreciation of 70,000 and included a profit on disposal, that's capital gain of what? 97,000. The company had incurred borrowing cost of 70,000 in the year, of which 10,000 was capitalized, right? Of which 10,000 had been capitalized in accordance with IAS 23. The company holds right of use assets, that's IFRS 16. During the year, the lease finance charge was 15,000 and then rentals paid were 80,000. At 1st January 2024, the tax written down value of machinery was 120,000 and for building was 60,000. CN Limited paid court fines of 125,000, which were included in expenses for the year, and they give us the tax regime. Now, I said we are giving tax regime because every country has its own tax regime. What is deductible in one country might not be deductible in another country. That's why the standard did not allow or did not mention any specific deduction that this is allowed, this is not allowed, this taxable, is not. So here we're giving the tax regime. If you are not given a tax regime, then you have to apply your country's tax regime. You apply your country's tax laws, right? I'm saying all borrowing costs are deductible for tax purposes. So we are told that all borrowing costs are deductible. If you come here, the borrowing cost is 70,000. The total borrowing cost is 70,000, but they capitalize 10,000, meaning they expend 60,000. Then capital gains are not taxable. What does it mean? This is capital gains are not taxable. That's their tax regime. If capital gains are not taxable, here there's a gain of 97,000, which was included in profit. Okay, the gain was included in profit, and we are told that capital gains are not what taxable, so we have to go and less it. It was added to This was added before getting the profit, so we have to go and less it. Fines are not deductible. The 125,000 fine is not deductible, but it was deducted before getting the profit, so we have to go and add back. Lease rentals are deductible in full for tax purposes. If you come to the lease rentals, the rental paid is what 80,000, but the finance charge is what 15,000. So they less only 15,000. If you look at IFRS 16, you amortize the lessee. Okay, we will have to recognize right of use asset and lease liability, and we'll amortize the lease liability. So 150 was deducted as the expense, but the question said the whole 80,000 is deductible. That's what it means. Since the lease rentals are deductible in full. Accounting depreciation is not allowed for tax purposes. Depreciation is not allowed. The 70,000 here was not allowed, but they have deducted it. So you have to go and add back. Capital allowances are claimed at 10% per annum. Capital allowance is allowed. That's what the tax authorities they give in place of depreciation. They give capital allowance. 10% per annum for building and 50% per annum for machinery applied to the written down value at the start of the year. Tax is paid at 30%. Calculate the current tax payable by CN Limited. So this is very simple. We just bring the profit and we do the add back and deductions. Okay. So what's profit before tax? So the profit before tax are profits before tax here is 7979. Okay, so it's 789. Okay, thousand. Then okay, so let's do the add backs. Okay, so we'll add. Let's start from the first part, depreciation. Yeah, depreciation is 17,000. It was deducted, and expense was deducted. In the question, we were told that depreciation is not allowed for tax purposes, so we have to add back. We have to add it back. So we have to add depreciation. How much is it? 70,000. So we have to add it back. Then we have the next item. Let's go to the lease. Okay, we're told that now with the lease, if you come here, it says the company holds a right of use. We're told that the finance charge was 15,000. We see when you are done amortizing, we pick the finance charge to P&L, and then the 80,000 becomes your rental, the cash flow. So we don't record the 80,000 in the P&L account. From account side, we record only the 15,000. But from the tax side, from the tax authority, they are saying the whole 80,000 is what deductible. We have deducted only the 15,000. Okay, so what we can do is we can add back the whole 15,000 and go and let the whole 80. Okay, so we can add back so the lease. Okay, we can add back the 15 that we have what deducted and go and let the whole 80,000, or you can just go and let the remaining 80,000 sorry. So I'm saying we can add back the whole 15,000 and go and let the whole 80,000, or we can find a difference which is 65,000 and let the 65. The issue is that from the accounting side, they have less only 15,000, but from tax side, we can less the whole, we can less the whole 80,000, right? So I'm saying we can do it two ways. Either you add back the 15,000 and go and less the whole 80,000, or you can less the net. The net is 65,000, so you can go and less the remaining 65,000. We are supposed to less 80, they've less 15, so you can go and less only, you can less the remaining, you can go and less the remaining what, 65, right? You can go and less the remaining 65 because they've less 15. And then the fine, they've paid a fine of 125,000. That fine was included in expenses. So fines, and then we are told that the tax regime, he said fines are not deductible, right? They are not tax deductible. So you have to add them back. So these are the items that we have to what? Add back, right? Then when we sum, or what do we get? Let's sum it and come and add it to this one. Okay. So when we sum, we'll get 1,000, right? So let's add the 1,000 to the 789. We add, so we add and we get 999,000. Then let's look at the expenses to less. Okay, so let's look at those to less. Now we are going to less the capital gain. Okay, so we are going to less the capital gain. How much is the capital gain? The capital gain is 97,000. Now we are going to less the 97,000 because it was included. It's a gain. It was added to income, right? So it increased profit. It was added to income. It increased profit, but we're told it's not taxable. So you have to go and what? Less. Okay. So the capital gain. Then we also have the lease payment. The lease payment, we can now come and less the whole 10. The lease payment, how much is 80,000? And with the lease payment, I explained the difference. I said you can decide not to add the 15 up there and then come and less only the 65,000 difference because they've already deducted the 15,000. Or you can add the 15,000 back and come and less the whole 80,000. Then let's go and look at the borrowing cost. With the borrowing cost, we're told that the company had incurred borrowing cost of 70,000 in the year, of which 10,000 has been what capitalized. So the total borrowing cost is what 70,000. They've capitalized 10,000. If they have capitalized 10,000, it means they have expensed 60,000. That's how they did it. They incurred 7,000, they capitalized 10,000, and they expense 60,000. So they brought 60,000 to P&L. But the question is saying that where is it? Where is it? Here. No, I'm looking at it. Okay, here. All borrowing costs are deductible for tax purposes. All. So all the 70 is deductible, not only the 60. And because they have deducted 60 already, you have to deduct the remaining 10. Are you following? So we have to find the difference between the 70 and then the 60. So this 10, that was capitalized. We have to what? Expense, come and less it because it's deductible, right? It says the whole 70 is deductible for the borrowing cost, but we have deducted only the 60,000 that we have expensed and we've capitalized 10. So we now come and then less the 10. It's deductible. So we have to deduct the whole 70, not only 60. So you have to come and deduct the remaining 10, right? So when you add all these ones, the 97, 80, and then 10, okay, you get 187. Okay, then we'll come and add the 187 to, sorry, we'll come and less. So we'll come and less the 187,000. Okay, and then after lessing, we'll get the accessible descent before we less the capital allowance. No capital allowance is allowed. Okay, so when we do it here, we are going to have our accessible. We are going to have our accessible profit. Okay, 999 minus 187,000, which gives us 812,000. So we have 812,000 Then now we are come and less the capital allowance. Capital allowance is less. You can let the capital allowance straightforward. You can less it straightforward there. So capital allowance, with the capital allowance, we have two items here. Okay, we have building. Since building capital allowance is 10%. So we are going to apply the 10% on the written down value here. Building 10% on the 600,000. Okay, so 10% of the 600 is what gives us the capital allowance for so capital allowance we can let's specify. So building, okay, we said building will be the 10% on the 600, 10% on the 600,000, and that'll give us 60. So let's come and let's it here straightforward. So let's let the 60,000 here. Then we have machine, capital allowance for machine. For machine, machine is 15% on the written down value on 120. So 15% times 120, and that will give us 18,000. Okay, so when we less this 10 here, we should get 73 something as a taxable profit. Okay, so we are going to get taxable profit. So that's the taxable profit from the GRA side. Okay, so we have taxable profit of 7, get 734,000. Okay, 734,000. Then your current tax. So now you come and apply the tax rate. So your current tax now will be the 30%. Okay, 30% on the taxable profit. So 30% times the 734,000, and that gives us 220, 220, no, 220, 200. So this will be the tax, the current tax for the year, right? So this is how we get the current tax. We have to adjust the accounting profit, right? So we have to do the adjustment, add back, and that add back disallow is not difficult. It's just like errors. Okay, if the expense is not allowed but it has been deducted, add back. If there's income that was added but it's not supposed to be taxed, go and less it. And one, so that's it with this. We've gotten the current tax of 220,200. Very good. So that's it with it. So we pick the profit before tax. We added all items that were supposed to add. We less all do that were supposed to work less, and we get our assessable something. So in place of depreciation, the tax authority they give capital allowance. So we normally disallow depreciation, we add depreciation back, and we grant or we less capital allowance, right? So let's pause here, right? In the next video, we are going to okay, so let's pause here. In the next video, we'll be looking at deferred tax, the last element. So we did the over and under provision, the first part, we did the current tax. We said with the current tax, you have to do add back and disallow, add back, disallow. Then when you get the taxable profit, you apply the tax rate on the taxable profit to get your current tax, right? Okay. So in the next video, we'll look at deferred tax. Okay. And then when we are done looking at deferred tax, we'll look at some special areas like revaluation, the impact of revaluation on deferred taxation. We'll look at other areas like share-based payments, and then some small impact of consolidation, right? The impact of the impact of deferred taxes on consolidation, or the impact of consolidation on deferred taxes, right? And then we'll be done with IAS 12, right? So if you've not subscribed yet, please subscribe. More videos will be coming, right? So please subscribe, share with your friends for me, and then that's it. So I'll see you in the next video.